markets are a moving target right now, and they are moving sharply lower on heavier than average trading volume. We're seeing the TSX trade at a multi-month low, down about 1%. It's a washout pretty much across the board, and a flight to safe havens, a flight to the bond market, a flight to the price of, a flight to bullion, I should say, even a little bit of a flight to Bitcoin, which we can talk about a little later. The VIX is also popping. A gauge of volatility is up about 8% right now, trading at a reading of 24. Let's bring in Eric Green, portfolio manager at Authentic Asset Management. You've seen a lot of cycles. Eric, you've worked at the Fed, you've been an economist, now you're an investor. So we're going to make use of all of those hats.
Good.
Maybe let's start with First Republic,
right?
Because they got this lifeline. It's not working out for the shares. You've got Bill Ackman saying this basically socializes the problem and is bad policy. Let's put on your policy-making hat. Is it bad policy?
Well, you know, one of the things that the Fed has to do is financial stability. That above all else. And so we talk about moral hazard issues. We've been going through moral hazard issues for many, many years now, so that isn't anything new. I would have thought that the backstop of deposits, even over 250,000, at least implied anyway, would have provided a little more stability into the system. It hasn't. I would have thought that the infusion of capital from those Wall Street banks yesterday would have done a little bit more for First Republic. And don't forget, investors loved First Republic. It was a gold standard bank. And that doesn't seem to be working. And it's fascinating to see how confidence channel works here. When you look at the SVB fiasco, there was an asset liability mismatch, but it's not obvious to me that had nobody really known what was going on, earnings would have been lower, but they wouldn't have gone through this. And so what we are looking at right here is a bit of a crisis of confidence. And the wider market is trying to tease out, well, at what cost do we get this pause in rates or lower terminal Fed funds rate? What's the cost in terms of growth and earnings and financial stability?
What can Federal Reserve, Treasury do about a crisis of confidence?
Well, that they can do exactly what they are doing right now. I was at Countrywide as the chief economist in 2007, 2008. So I saw how all of these programs can work and work on the ground and have an immediate impact. What they have to do is just indicate that we are there. We have the tools to backstop the system and provide liquidity. And that's exactly what they're doing. And now the other mandate comes into focus on next Wednesday. And the knee-jerk reaction is that, well, the Fed can't raise rates. Well, the reality is they're probably going to raise rates. The reality is it's probably a mistake just because they've already gone far enough. And what we've been seeing in terms of this whole bank issue is that it's tightening for the Fed. I don't know what the number, it could be 50 basis points, it could be worth 100 basis points, but this is going to supercharge the tightening that they've already had in the system. And I think that that's another issue that the market has to work through. Again, at what cost? So we're going into a period in which confidence is much, much lower, and where leading indicators are showing a significant risk of recession. I mean, it's never been this weak without having it. You've heard the story, and it goes on and on. But when you look at what's going on now over the past week or 10 days or so, the inability to shore up confidence adequately, I think we will get there because we always do. Then
the question, at what price?
At what price, right? What's interesting, we're going through this QT on the Fed's balance sheet. The balance sheet's actually expanding now because they're providing liquidity, which is the right thing to do. So there's a lot of cross currents going on right now, for sure. Bent
but not broken. We haven't seen, the S&P break through any significant levels. It has been under pressure, but, from Thursday to Thursday, it was actually up about 1%. So that is certainly coming out.
Right.
But when I'm listening to you walk through all the issues that we need to cross, I don't really see a meaningful reason to get in front of these markets because it doesn't look like we've pulled back such that it's priced any of that in.
Absolutely. It's really interesting, Amber. One day the market's up 1.5%. The next day it's down 1.5%. Now it's up and now it's down, and now this morning is down. And there's no meaningful answer in terms of why. And that's the reason. The reason is because investors are trying to grope through some of these risks. We broke through the 200-day moving average in the S&P quite significantly a couple days ago, and we bounced right back through it. Okay, now it's going back down through it again. So I don't think that has much meaning at this point in time. I think the reality is that we're going to start seeing significantly weaker economic growth. We've talked about this for months now in terms of what's looming. This just accelerates that risk. And it's really hard to have the view that if I felt, do I feel better about investing?
So we have talked about this.
Yes,
I just want to interrupt for a second. We have talked about this, but almost nobody said it's going to come from a California bank because of these things called held to maturity. Nobody called this.
Absolutely.
And so, you know, how did we miss it? Is that a problem that so many people missed it? And does that mean we miss, you know, the next?
We miss a lot of things, right? You know, I've been doing this long enough to remember we missed long-term capital. We missed Orange County. We missed in 2007, 2008. Just look at all the things that we missed. I remember in 2007, the storyline from the Fed is that, hey, we can contain $500 billion in subprime exposure. It's not a problem. So it's hard to see where these issues creep up in the darker corners of the financial system. I didn't have any awareness in terms of how SVB had been managing the asset liability mix. And I can tell you, if I couldn't do anything different than that. And investors can't understand that either. The reality is, when you create this change in regime, and we've talked about this a lot, we're ultra accommodation to tightening at the fastest rate since Paul Volcker sat in the chair. You understand that things going to be, you know, the risk of something happening is there. Now, the natural question is to be, Eric, where is this next risk coming from? And I can't tell you. But I do know that policy rates are going to go higher. I think we have a rate hike next week, and it's the last one of the cycle.
Okay.
And then we just have to wait and see what is the fallout, how is confidence contained, and to what extent are there other shoes to drop.
So that means that the terminal rate, you're saying, is going to top out here for 4.5, 4.7. We're not going to get to 5.
That's very reasonable.
Okay.
Yeah, I mean, it's functionally 5.
Because last week that was a totally
5.
different story. We were going up to 5.6.
I know.
Okay,
I know.
so a lot happened in a week.
A lot happened in a week. And if you look at a week ago, for example, what were the consensus trades? Like long oil, short duration, long value stocks over growth. Now what are you seeing? You see a big rethink across all of these different areas. And you had mentioned gold at the outset. You gotta love gold here, right?
Do you?
Yes. Well, two things that gold loves, right? Lower real rates, which they're getting, and systemic risk, right? And I think both of those are coming in. And so I think gold looks to be very positively supported here. Silver, copper, silver, yes, copper, less so, certainly. And energy less so. But again, you know, the writing was on the wall in terms of where we were moving towards, where the risks were. I think you have to look at this over the last week or so, is that I feel worse about this.
And so gold, to your point, is trading at more than a one-year high. It historically kind of topped out above 2,000. Do you think that this is enough to push it meaningfully above 2,000? Do you get in the business of forecasting that?
Well, I used to at TD, right?
Yeah.
So we used to run commodity research in my old job. So yes, I think all the tailwinds are there. And don't forget that this other tidbit, central banks also like gold. Because there's a lot of central banks who are trying to get away from dollar reserves for a variety of geopolitical reasons. So I think the tailwinds to gold are looking quite positive right now. The problem is that it could come at a cost in terms of the welfare of the economy and other parts of the financial market.
I'm thinking about, you know, a previous regime in Europe where things were obviously much worse during that time, and the phrase "whatever it takes," Mario Draghi coined it, and that was his motto. Do you think you see a return to that? If, you know, all these measures, they don't seem to be working in terms of instilling confidence in First Republic, and if they don't work there, who knows what the other shoe is to drop. If we're getting this recession, inflation will take care of itself. Do you see a return to the helicopter money, the big bazookas, the whatever it takes?
No, I don't. And I would emphasize 2 points. Number one, this is not 2008. The big money center banks, which are now a flight to quality as opposed to a flight away from quality, are extremely well capitalized. So we don't have a systemic banking crisis per se, right? So we don't need gobs of money being thrown at it. That's the first point. The second point is that inflation is just simply higher now than it was back then. Remember, back then, inflation had been steadily declining going into the crisis of 2007 and 2008. Now we're in a whole new regime, and we've talked about these issues too, in which inflation has shifted permanently higher, in my view, 50 to 100 basis points. So that's not the recipe of helicopter bet, if you remember. So,
I do remember.
And I used to tell investors all the time, look, this whole monetary structure worked as long as inflation was low. Blow up the balance sheet to 100 trillion. It wouldn't matter if you had low inflation.
Yeah.
Problem now is that we no longer have low inflation. So now you have to work through a greater balancing act. And interestingly enough, the Wednesday meeting of the Fed is really emblematic of all these different forces coming through. I thought the ECB pulled a marvelous rabbit out of the hat.
Yeah.
But
why?
very much
Because
further
they
behind
raised,
the curve than we are.
but then said we're data dependent now.
Yeah, so it's this term called the dovish rate hike, which has a certain level of elegance to it. But don't forget, the ECB was also significantly well behind the Fed and where they were in terms of real policy rates relative to where inflation was. So there was more of an urgency for them to do it and then sort of say, hey, this may be it. We'll see how things evolve from here. But from the Fed's perspective, I think 25, from an economic perspective, is meaningless.
Now, if you're calling for the next rate hike to be the last one of this cycle, I think, shouldn't I get excited about that as an investor? I've already gotten really excited about tech stocks in the last week just on this rate repricing. Why shouldn't I just go pile back in?
Because it's coming at a cost, okay? It's coming at a cost where inflation is still high. Now, we talk about inflation going lower. My question is lower to what? And I think 3%, is it 3.5%? But it's not going back to where it was. This has been a really unique period, and we've talked about these again in terms of how the Fed has hiked much more and much longer in relation to the peak in core inflation. And the reality is it's continued to do so into a lot maybe in hindsight we look, what were we thinking? We're looking at the yield curve, looking at these leading indicators, we're looking at all of these risks. Why couldn't we see a company? I cannot get excited to pile in when the cost of capital is going to be higher because of this crisis, number one, if the policy rate is at 5% as opposed to 5.50 or 5.75, because the earnings side of the PE equation is what worries me. And it should worry you too.
My buy the dip mentality is showing.
Well, I think it's worked. And if you bought all the I mean, look at growth stocks of the past week. But there's a level of speculation ethos in this market that persists.
So I want to think about the great investors, and they buy, when there's blood in the water, and so regionals, right? Is there any reason, any way that you can find that you can do it? A few of them are going to survive. I can buy these dips.
Oh,
this
absolutely.
Panic selling.
Absolutely.
Would you get in front of any? I know you wouldn't get in front of Canadian banks, and we talked about that before. Yeah. What would you get in front of here?
Well, let me just say, I know Warren Buffett is famous buying when there is blood in the water in this panic. Well, there's another saying, don't catch a falling knife. Yeah. Okay. So to what extent are you catching a falling knife, or are you actually prescient in terms of buying at this point in time? When you look at a blue blood regional bank like First Republic.
That's true.
And they seem to have everything going for it. Now their earnings are going to be permanently compromised because they're having to hoard reserves. They're having to raise what they're paying.
But they were in California. What if they were in Chicago? Would they be fine?
I don't think it's a function of geography.
You don't think it just got tied up?
I really don't think it's a function of geography.
Okay.
So it's just a function of a lack of confidence and fear. And don't forget, there's also the potential for people to take advantage of the situation as well in terms of trying to push rumors and things of that nature. So Is First Republic going to survive? If you listen to J.P. Morgan's note today, yes, this could be a great buy or it could be a really bad one, right? And that's sort of how we look at this. It's almost binary. If it's a good buy, it's going to be a really good one. And if it's a bad buy, it's going to be a really bad one. So
I only have like 10 seconds with you. So you don't want to go headfirst into equities. You want a big gold exposure. Anything else?
yeah, I like we have a position in terms of wider credit spreads. We really like that.
Okay.
I think you have to look at this in a very defensive fashion.